Tech selling off this morning. Joining us now is Paul Meeks, portfolio manager at Independent Solutions Wealth Management and professor at the Citadel's Baker School of Business, and Chris Caso, managing director at Raymond James. Good to see you both. Chris, I'll kick it off with you. You know, we are looking ahead to earnings season as well. Let's not forget that. So the sell-off in technology, it may be pretty well timed as a setup to earnings.
Well, you know, more recently, Apple's had a pretty good run over the past couple of weeks. And, you know, we think that was generally because it was just a laggard from the beginning of the year. You oftentimes with Apple see a bit of a seasonal trade as you go into the next iPhone launch in September. And that's one of the reasons why that could have happened.
Paul, what's your take on this sell-off here? Because, you know, many people believe lower rates actually benefit technology. Tech is seen as defensive, and yet here we are, red hours across the board. Granted, a lot of these stocks are down now from all-time highs.
Yeah, we've had a unbelievable, as you know, rotation in and then out of the sector and then back in. And so I actually think this most recent rotation out of the reopen the economy, value-oriented trades into tech is actually probably overdone. I'm a little bit more worried about the spike in inflation and rates that I still think could be coming. And so I think this is just some comeuppance because, as you said, you know, tech has been on a rally for the last couple of weeks. And I actually think it's probably too much too soon.
Chris, to what extent, if any, do you take a look at the bond market and try and figure out what it is telling you? Does it educate your view on how, let's say, an Apple would trade, for instance?
It really doesn't.
So Apple,
and,
go ahead, Chris.
I'm sorry. Yeah, sure. It really doesn't. And, you know, our premise in Apple, we upgraded the stock in mid-2019 on the premise of a 2-year 5G iPhone cycle. We're midway through that. And we just follow the fundamentals. And, you know, we think in the case of Apple particularly, you didn't unlock all that value last year because of COVID. The phone was late. A lot of stores closed. And, you know, we think you catch up on that this year.
There are low expectations. This is according to JP Morgan when they raised their price target by $5 to 170 on Apple earlier this week, Chris. Low expectations for the iPhone 13. Does that create a good setup for Apple, in your view?
I think it does. And again, you know, what was characterized by last year was the fact that, you know, they just couldn't sell as many phones as you otherwise would have because the phone was late, stores were closed. But the good thing that happened last year was that the mix of iPhones went to the high end and more people bought Pros and Maxes than the low models, and actually caused a little bit of an issue for Apple too because they didn't realize that and they didn't make enough of the high end ones. This year we think they fixed that. So, you know, we think the benefit this year is you get some catch up on the units because you have a full selling season on it, but the mix toward the high end is permanent. And we think that's what's important. We think that's what drives numbers higher.
Shepard Smith here. Thanks for watching CNBC on YouTube.